Welcome to the 3 Edge Week in Review for the week of September 13th. I'm Fritz Folts, the Chief Investment Strategist at 3Edge, and I'm joined here once again today by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. After a brief hiatus during the month of August, Steve and I are excited to be back, exchanging our latest investment thoughts and ideas with our listeners. Today, along with a brief update of the global capital markets, Steve and I will be discussing if the global capital markets are about to experience at least the beginning of the end of the U.S. Federal Reserve's extraordinary monetary policy response to the onset of the coronavirus global pandemic, and what that could mean for the market and for investors. Before we get to that, let's do a brief recap of the activity in the global capital markets. And since we said goodbye to summer a few weeks ago, the month of September seems to be living up to its reputation of oftentimes being a challenging period for equities. The S&P 500 has experienced losses in 8 of the last 10 trading days as investors contemplate a myriad of potential risks, and the thread that seems to run through many of these is the continuing economic impact of the Delta variant of the coronavirus on the global economic recovery. Investors also keeping a close eye on China after the enactment of a series of restrictive government policies, and where a major property developer is falling further and further behind on its debt payments. Then, of course, next week, once again, we will all be laser focused on the Federal Reserve's FOMC meeting to see if it provides any clarity around the Fed's stated intention to begin to taper their monthly bond purchases. So now let's get to today's topic, the beginning of the end. And when we say the beginning of the end, in this case, we just mean the potential for the beginning of the end of the extraordinary monetary policy enacted by the Fed to combat the onset of the coronavirus global pandemic. So Steve, since the outbreak of the pandemic, aggressive monetary policy measures from the Fed here in the US have certainly been supportive of the equity markets, to say the least, right? And so it's kind of no wonder that as we made our way through this year and the global economy began to open, granted in fits and starts, investors have been focused on when the Fed might begin to unwind their stimulative monetary policy measures, and as they like to say on Wall Street, to take away the punch bowl. So here we are, mid-September. Fed has stated their intention to begin to taper, either later this year or perhaps early next. So are we finally seeing the beginning of the end? And what could this mean for investors going forward?
Well, Fritz, I think we're at the peak of this extraordinary monetary stimulus right now. So soon we may be looking back and saying we're now past the peak of the monetary stimulus. Now, just to review, the stimulus comes in 2 forms. One was when the Fed dropped short-term interest rates virtually to zero, or just a tiny hair above zero. And that will continue for some time. But the second is beyond that, they created reserves out of thin air and used those reserves to purchase securities on the market, like treasuries and other securities. And that had a direct impact inflating asset prices like the stock market. Now, I want to refer to a chart that shows this extraordinary monetary stimulus by creating reserves and adding to the balance sheet. Now, the Fed has been around for over 100 years. So it's taken 100 years to get to a balance sheet where they hold $8 trillion, roughly $8 trillion worth of assets, mostly treasuries. Almost half of that has occurred just in the last 18 months. That is extraordinary. And it's no accident that this extraordinary money printing is coinciding with an extraordinary run in the US stock market. I'd like to show the second chart. And you can see the spectacular run in US stocks. So it's right to ask, is this sustainable? Or is this going to be impacted as the Fed starts to withdraw or reduce their stimulus? Now, there's an old rule of thumb that operated before this massive quantitative easing or adding of reserves occurred. And it was called 3 steps and a stumble. And the idea was that the Fed would anticipate inflation, they'd begin to raise interest rates, but the stock market wouldn't get affected until after 3 interest rate hikes. And that's been the way, good rule of thumb for many years. But ever since financial crisis, when the Fed has actually been creating these massive reserves and adding to the balance sheet, that rule has not really worked. And there's a psychological impact that once the Fed thinks about tightening or announces they're going to tighten or begins to taper, then we have seen some impact in the stock market. So this is a time to be wary.
Excellent. So I think we could certainly argue that the Fed is perhaps the most important of the world's major central banks, but they're certainly not the only central bank to have, gone to the stimulative monetary policy measures over the past 18 months in their response to the global pandemic. So if we're seeing at least the beginning of the end of the extraordinary U.S. monetary policy that's driven U.S. equities in particular to record highs, how should investors think about the Fed's potential tapering in terms of the world's other major central banks? And could this impact the investment landscape?
You're right that the Federal Reserve Board is the major central bank in the world because the dollar is the world's reserve currency. Often other central banks just copy what the Fed does. But this time, we're seeing that the central banks are not all in sync. It is true that the European Central Bank seems to be copying the Fed, both in its inflation policy and also recently, along with the Fed announcing that they're thinking about tapering. But that is not true in certain other central banks. For instance, in Japan, not only are they far away from any kind of taper talk or reducing stimulus, they're actually talking about increasing stimulus or adding more stimulus packages. Also in India, they have no inclination to tighten at this time, and certainly not before they have their elections down the road. And so I don't think it's a coincidence that in September, as we get closer to this possible tapering announcement, the U.S. stock market is down about 2% this month. The stock market in India is up over 1%. And in Japan, it's up around 5%. I don't think that's a coincidence.
Right. Excellent. Well, thank you very much for giving us that insight into not only the Fed, but the other central banks and how we could be seeing the investment landscape changing and how that could affect investors. I do think, it's also important to point out that any potential shift in monetary policy, it's not like a light switch, right? It's not either on or off, but rather, tapering once it begins plays out over the course of many, many months. And so, at least so far, the Fed has been able to distinguish between tapering of their bond buying and not having to mention anything about raising interest rates. And I guess for now, anyway, the market is seeing it that way as well. But we'll have to see how that plays out. But regardless of the timing, it's going to be a very interesting end to 2021. So that will do it for Steve and me, but we'll be back next week with another edition of the 3Edge Week in Review. All of our videos, remember, available on our YouTube channel, as well as on our website, which is 3edgeam.com. Also, please feel free to share the videos with anyone who you think may find them to be of interest. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.